If you maintain a checking account and you're past 60, the IRS silently updated 3 regulations this year, and none of them reached your mailbox. No notice, no broad disclosure. Simply fresh enforcement protocols hidden inside revised compliance priorities, and most retirees currently remain unaware it affects them. I'm addressing all 3 today. The figure you once tracked that no longer shields you. The routine banking routine the authorities now view as a warning signal, and the relative payment that might silently convert into reportable earnings. Remain through the finish. The final point represents the vulnerability most retirees already carry without awareness. Hey, I'm Daria. I explain monetary and regulatory details each week that genuinely assists you safeguard assets you've accumulated and simplify retirement oversight. So if that serves you, please subscribe so you catch future updates. Here's Regulation 1. The figure most retirees recalled stood at $10,000. Remain beneath it. The prior view held, and protection followed. That perspective now falls short. Pursuant to the Bank Secrecy Act, every cash movement exceeding $10,000 within 1 business day still obliges your bank to submit a currency transaction report to FinCEN. Your name, social security number, birth date, and precise transaction timing submitted inside 15 days. You'll never receive a duplicate. The bank faces legal restriction against notifying you. What shifted in 2026 concerns what the IRS monitors beneath that figure. Revised directives now focus on accounts displaying repeated deposit sequences under $10,000, particularly among retirees obtaining steady benefit inflows, relative payments, or pension payouts. The limit no longer serves as your safeguard. The surrounding sequence does. A further filing most retirees never hear about carries no amount minimum whatsoever, a suspicious activity report, or SAR. A bank may submit one for a $200 movement. Software identifies it by monitoring conduct, not sums, and notification never reaches you. Federal statute criminalizes any bank staff alerting you, with penalties reaching 5 years incarceration. Also relevant, money orders and electronic transfers above $3,000 compel the bank to confirm and log your identity under identical statutes, although no filing occurs at that stage. It represents a reduced form of the identical documentation the authorities already retain. This extends equally to credit unions and large banks. No waiver exists for modest or community entities. Should you have relocated funds to a credit union, assuming it evades these standards, it does not. All federally protected entities adhere to identical Bank Secrecy Act obligations, indicating the prudent action avoids changing institutions. It involves grasping what genuinely initiates a filing initially. That connects to Regulation 2. Which converts a normal practice into a federal signal. Consider Diane, 67, a former county clerk in Albuquerque. Across 11 years, she took out $800 cash biweekly for living costs. Following her spouse's passing, she increased it to $1,000 for obligations he previously managed. 6 weeks afterward, her bank system marked the account and submitted a SAR. Diane committed no error. She was adjusting finances as a widow, yet the mechanism interpreted her regularity as avoidance. Diane learned of the SAR only later, during an ordinary account check at her bank that noted discrepancies linked to the prior filing, prompting a compliance officer to request details on her altered withdrawal sequence. She resolved it since she retained prior receipts proving the rise aligned with new expenses, assumed post her spouse's death. Yet she mentioned having no prior knowledge until that discussion that any filing had occurred. This constitutes structuring. Under Title 31, Section 5324, an intent is unnecessary. It solely needs a sequence resembling an effort to avoid the filing limit. Steady withdrawals of fixed sums below $10,000 meet criteria, irrespective of origin or legitimacy. Should cash usage continue regularly, the solution involves records. A basic entry, each instance noting date, sum, and reason. When shifting bigger amounts among personal accounts, execute one movement rather than multiple smaller actions. Ahead of the final regulation, review your prior 90 days of activity. Should 3 or additional deposits appear between $5,000 and $9,500, record it. You'll require this for later instructions. Now, Regulation 3, covering funds never perceived as earnings. Your daughter forwards $400 via Zelle for food. Your son forwards $600 via Venmo for vehicle fixes. None registered as earnings, yet under refreshed 109K guidelines, third-party services like Venmo, PayPal, and Cash App must disclose total payments into your account after reaching a defined yearly limit. $2,500 for 2025 activity, advancing towards $600. Zelle functions separately as it handles direct bank movements, thus escaping this filing requirement, though the funds remain taxable when tied to business activity. Once a processor discloses those movements and you omit them from your filing, the IRS system detects the discrepancy automatically. That notice is termed a CP 200, not an examination, but a suggested correction, including accrued interest. Patricia, 71, a former home health worker in Memphis, received one during March, asserting she owed $1,840. She had not labored that year. Her 3 grown children forwarded her $3,200 combined via Venmo, covering medications, obligations, and a replacement appliance. The IRS cross-checked the 109K to her filing and identified an omission. She possessed 60 days to reply prior to automatic determination. The remedy: request relatives add personal gift in the note field when transferring funds and maintain basic records. Gifts do not count as taxable earnings for you, yet proof is essential to confirm their nature. One additional detail most retirees overlook: the IRS typically holds 3 years from your filing date to review it, yet that period extends to 6 years when unreported earnings exceed 25% of reported totals. Consequently, a payment service discrepancy from 2 or 3 years prior may still appear now, even absent notice at the original time. If regular relative transfers via these services have occurred over years without records, reviewing several prior years of service history now proves worthwhile. Beyond just recent activity, preventing surprise from a notice referencing a forgotten year. So here's the request: the exclusions, the advantages, the reimbursements most retirees qualify for, yet overlook. I've compiled them centrally, state by state, document by document, preventing lengthy searches across official resources. All presented clearly and directly, enabling any retiree to locate relevant items. Regardless of location, funds remain unclaimed. It's titled The Senior Exemption Playbook. It's located in the initial pinned comment beneath this video. Simply select it and access all details. Now, remain here since the final regulation represents the issue most retirees already face unknowingly, and it explains why this video exists. Here is the sequence and complete them sequentially. Step 1, obtain your free check systems report and examine it for alerts or closures previously unknown. Step 2, across the coming 90 days, note each repeated deposit, origin, sum, date. When relatives transfer via service, secure a brief confirmation from them verifying it as a gift. Step 3. Combine any intended movements among personal accounts into one action rather than multiple with a short note explaining intent. Step 4. Total all Venmo, Zelle, PayPal, and Cash App receipts across the prior 12 months. Should it surpass $2,500 and absent from your prior filing, compile records now ahead of a CP 2000 arrival. Step 5. Should a CP 2000 appear? Reply in writing prior to the notice deadline, typically 60 days from the printed date, not receipt date. Provide a short clarification, records, and signed declaration. Should the suggested sum exceed $5,000, consult a licensed tax advisor initially. Step 6. Apply a free security freeze to your check systems record if new accounts are not planned soon. It leaves current accounts unaffected, yet restricts how sequences reach screening systems ahead. None of these 3 regulations included alerts. Your bank cannot disclose a SAR filing. The payment service provides no notice upon reporting relative transfers. That quiet forms part of the statute. Grasping the true regulations and recording consistently prevents a silent alert from developing into an actual issue.